Okay, let's unpack this. Imagine the market as like a high-stakes chess match, right? Where every single move counts, and both players are just staring at the same crucial squares. This week, that's July 14th through 18th, 2025. It's exactly that kind of moment. It really is. We're talking about a head-on collision, basically, of two massive forces. The very latest inflation data and, the official start of earnings season, kicked off by some of the biggest names in finance and tech. It's a fundamental tug of war, pitting the economy's vital signs against how corporate America is actually doing. So our mission in this deep dive: cut through all that noise, look at the key sources, and, arm you with the playbook. Help you really understand how these real-world company results are going to battle against those big macroeconomic pressures. The goal, like always, is to give you that shortcut. Help you get genuinely well-informed about the week's market dynamics, clarify those opposing viewpoints, and maybe deliver that aha moment. Now, here's where it gets really interesting. The sources we've looked at, they lay out a week that's just completely centered on inflation.
A pivotal moment, really, that could fundamentally shift what the Federal Reserve does next. And the spotlight, it's squarely, intensely on Tuesday.
That's absolutely right. Tuesday, July 15th, 8:30 a.m. Eastern Time. That's when the Consumer Price Index, the CPI data, drops. And it is, without a doubt, the primary catalyst for the entire week. I mean, most of you listening will probably track this number religiously anyway, but this week, its core component, specifically, that's going to be the real battleground, for the doves and the hawks inside the Fed. We're looking at consensus forecasts, 0.2% month over month for the headline CPI. That's up just a tick from 0.1% previously. And core CPI is expected at 0.3% month over month, also up from 0.1%. Year over year, headlines looking like 2.6%, up from 2.4%. And crucially, that core CPI number is expected to hit 3.0%, up from 2.8%.
If I'm hearing you right, this isn't just about a tiny tick up or down. It's more like pour. It's about settling a pretty fundamental battle within the Fed itself. Yeah, we just saw those FOMC minutes, how divided they were. So the CPI report, it isn't just about if they cut rates, but maybe which side gains the upper hand, setting the tone for policy for maybe months. That feels like the real insight we're hunting for Tuesday morning.
Precisely, yeah. The direct influence of these numbers is just immense. A hot core CPI, let's say it lands above that 3.0% year-over-year mark. Well, that would directly challenge the whole disinflation story everyone's been kind of hoping for. And that would likely send Treasury yields higher, especially that policy-sensitive two-year note, right? Because investors, they demand more compensation when inflation's eating away at purchasing power. And it would definitely put significant pressure on growth stocks. Their valuations are super sensitive to those lower discount rates. On the other hand, though, a downside surprise. A cooler number? Oh, that would absolutely pour fuel on those September rate cut hopes. You'd likely see a strong bond rally, a broad risk-on move across equities. It really could be the green light the market's been kind of waiting for.
Fascinating. Okay, so CPI on Tuesday is clearly the main event, the elephant in the room. But sometimes, what comes after can either, confirm the first signal or totally muddy the waters. Is there another inflation indicator this week that could play a big role there? Validating or challenging Tuesday's story?
Absolutely. Good point. Following right up on Wednesday, July 16th, at the same time, 8.30 a.m. ET, we get the Producer Price Index, the PPI. Consensus expects a 0.2% month-over-month increase there. Now, this data is significant because it measures wholesale inflation. Basically, the prices producers are paying for their inputs. So it acts as a kind of leading indicator for future consumer prices. Its role this week, primarily, it's to confirm or contradict that CPI narrative. If CPI is hot and then PPI comes in hot too, well, that just amplifies the negative signal, almost certainly locks in a hawkish Fed stance, I think. But if CPI cools and then PPI also cools, that reinforces the positive, right? It fuels those cut expectations even more. A contradictory reading, though. Say a hot CPI, but surprisingly cool PPI, that could introduce some uncertainty. It might suggest that while current prices are high, maybe pipeline pressures are actually easing down the road. That'd be a more nuanced read for the market.
All right, so we've got the prices themselves covered. But, as inflation maybe tightens its grip, the big question is always, how are everyday people, the backbone of this economy, actually holding up? That brings us to Thursday's data, right?
Exactly. Thursday, July 17th, 8.30 a.m. ET, we get the advanced retail sales data. Consensus is looking for a 0.3% month-over-month increase. But you got to remember, May was surprisingly weak. It was actually down 0.9%, a decline. This is a really critical gauge. I mean, consumer spending is roughly 2/3 of the U.S. economy. So yeah, it matters. A strong rebound would normally be seen as positive, right? It shows resilience, the consumer's still spending. But in this kind of inflationary environment, it's kind of double-edged sword. It could actually give the Fed more reason to keep rates higher for longer. Instead of cheering the strength, it's complicated. What's particularly concerning, and it's a scenario Jamie Dimon, JPMorgan CEO, has actually warned about, is what we call the dangerous scenario for markets. That's a hot CPI followed by weak retail sales. That's that stagflationary cocktail idea.
I mean, the worst combo.
Yeah. It means high inflation hanging around while growth is slowing down, if we see that. It would basically tie the Fed's hands. They couldn't really cut rates to support growth because they'd be terrified of fueling even more inflation. So a second week retail sales print in a row, especially if CPI stays stubbornly high, that would raise serious concerns about a broader economic slowdown. And frankly, leave very few places for investors to hide. That's the kind of economic knot that really keeps central bankers up at night, for sure.
And just to round out this really intense macro-focused week,
Yeah.
how are people actually feeling about all this economic messiness? It's not just about the numbers, but what everyone thinks is happening, right? Their psychology matters.
Yeah, definitely. We cap off the macro data dump on Friday, July 18th at 10:00 a.m. ET with the University of Michigan Consumer Sentiment Survey. Consensus is looking for 62.0, up just a little bit from 60.7. Now, while the headline confidence number gets attention, the really crucial bit, the thing the Fed watches very closely, is the inflation expectations component within that report.
Okay. Why that specifically?
Well, because expectations of future inflation can actually become a self-fulfilling prophecy. They influence wage demands, pricing behavior across the whole economy. So if we see a spike in those inflation expectations, that would be a clear hawkish signal for the Fed. It could potentially overshadow even a weak headline confidence number. It really shows how consumers are internalizing all this economic data.
Okay, so we see the battle lines drawn with the inflation data. That gives us a clearer picture of the macro landscape. Now let's pivot to the other major player on the field this week, the companies themselves. Earnings season is about to give us that ultimate tangible reality check, moving from abstract data to actual corporate performance. What stands out?
Indeed. Yeah, the Q2 earnings season really kicks off properly with just a barrage of banking reports. Tuesday and Wednesday, July 15th and 16th. We're talking JPMorgan Chase, Bank of America, Goldman Sachs, Morgan Stanley, the big hitters. And these major banks, they offer this truly unique viewpoint into the actual health of both consumers and, corporate America. I mean, CPI is a government statistic, right? But a bank's report on, say, credit card delinquency rates or small business loan demand, that gives you a tangible, real-time indicator of economic health that no government survey can quite capture in the same way. They're right there on the front line, so their words carry, immense weight.
So, okay, beyond just the headline earnings per share or revenue, what specific metrics inside those bank reports are you going to be zooming in on?
Right, for the financials, we'll be watching several key things. First, net interest income, NII. That's basically their lending profitability. JPMorgan specifically has promised more color on its NII path this quarter. So that commentary will be dissected, heavily scrutinized for any shifts in their outlook on interest rates. Second, loan loss provisions. That's the money banks set aside for potential defaults. If that number jumps significantly, it signals rising concern about the health of their loan books, a direct read on potential consumer or business stress.
Makes sense.
Third, trading and investment banking revenues will be looking for, signs of life in M&A IPO pipelines. That usually indicates broader economic confidence, appetite for risk. And finally, the management outlook. What influential CEOs like Jamie Dimon say? Any warnings on inflation, tariffs, that stagflation risk? It all matters. What's really key here is how strong bank reports might actually mitigate market fears, even if CPI comes in hot. Congesting the economy can handle higher rates if corporate health stays strong. It's a potential counter-narrative to just the macro concerns.
That's a crucial point. Okay, so while the banks give us that broad economic pulse, this week also features a deep dive into a specific, really high-flying sector, tech. And leading the charge there on Thursday is the streaming giant Netflix. What's the story there?
Right, Netflix.mflx. They report after the market closes on Thursday, July 17th. Now, this company, as you said, has been a massive outperformer. Its stock has just surged over the past year, mostly thanks to that successful transformation they pulled off, right? The password sharing crackdown, rolling out the ad-supported tier. They've genuinely rewritten their own story. It's been impressive. However, the key challenge now, the bar for this Q2 report is just incredibly high. The stock is already priced in a ton of success. That creates a really high beat and raise hurdle for them. Some fair value estimates out there are actually well below the current price, which suggests, some valuation caution and maybe an asymmetric risk profile.
Can you unpack that a bit? Asymmetric risk profile. What does that mean exactly for someone holding Netflix stock right now?
Sure. Yeah, an asymmetric risk profile basically means there's a greater potential for a negative reaction if they disappoint compared to the potential positive reaction if they deliver a strong beat. Think of it like this. The upside for the stock might be kind of capped because so much good news is already baked in, but the downside, that could be wide open if they
Yeah.
stumble even just a little bit.
Okay, got it. High expectations mean high potential for pain if they miss.
Exactly. For Netflix, the critical factors for the stock's reaction will likely be, first, ad tier monetization. Management guided for that ad business to double in 2025. So any update on that progress is absolutely crucial for the long-term bull case. Second, forward guidance. Any hint of slowing growth, maybe margin pressure perhaps from spending more on content like live sports, or just a generally cautious outlook for the second half of 2025, that could trigger a pretty significant sell-off. And third, while the focus has definitely shifted away from just subscriber numbers, a really major miss on subscriber growth, that would still be viewed negatively, no doubt. It really sounds like Netflix is walking a tightrope. Huge success story, yes, but even a tiny stumble could be disproportionately punished by the market this time around.
So we've got the market's pulse from inflation. We've got corporate America's health check from earnings. But who holds the ultimate lever that pulls it all together? That's the Federal Reserve. And this week, their voices are going to be particularly loud, reacting almost in real time to everything we've just discussed.
Oh yeah, the sheer number of Fed appearances this week is truly fascinating. You got to remember, those June FOMC minutes, they highlighted a really clear split. Members who see a path to cutting rates this year and those who just don't. That division makes every single public comment a potential market-moving event. And the crucial factor is the timing of these speeches relative to the data releases.
Right. Anything before Tuesday's CPI is basically old news the second the data hits.
Exactly. It's stale upon release. The most important commentary will come after the market has had time to digest the key data, CPI, PPI, retail sales. You'll want to listen really carefully for shifts in tone. Do they sound hawkish before CPI, but then maybe a bit more dovish after a weak reading? That's the real signal you're looking for.
Okay, so what's on the schedule? Who should we be paying closest attention to?
We've got several key speeches lined up. On Tuesday, July 15th, importantly after that CPI print, we'll hear from Vice Chair for Supervision Michelle Bowman and Governor Michael Barr. These will be the first official reactions to the CPI data. The market's going to compare their tone to whatever they said before CPI, just to gauge the data's immediate impact inside the Fed. Then on Thursday, July 17th, it's a packed day. We have Governor Adriana Kugler speaking at 10:00 a.m. Eastern on the housing market and economic outlook. Then Governor Lisa Cook speaks at 1:30 p.m. Eastern on AI and innovation. Now, while that sounds specific, it could actually have long-term implications for how the Fed views the neutral rate of interest. So, kind of interesting. And finally, the big one, arguably. Governor Christopher Waller speaks Thursday evening, 6:30 p.m. Eastern on the economic outlook.
Waller. He's considered a key voice, right?
Yeah. Very much so. As a key voice on the FOMC, his interpretation of the week's full slate of data, CPI, PPI, and retail sales will be the most comprehensive synthesis we get from a policymaker. His words will carry the most weight and have the highest potential to really shift market pricing for that next FOMC meeting. And when you're listening to these speeches, you'll want to listen for specific code words, maybe. If speakers start using phrases like nascent weakness or maybe deterioration in credit quality, especially after we hear from the banks, that would suggest their focus might be shifting away from just pure inflation fighting towards a more balanced view of their dual mandate, which, remember, includes employment. Conversely, if they keep emphasizing stubborn or persistent inflation, well, that just confirms price stability is still priority number one. Suggests rates aren't coming down anytime soon. Every single word will be scrutinized.
Okay, this confluence of inflation data, earnings, Fed speak, it just screams significant market movements ahead. So let's try to lay out some potential scenarios for you, the listener. Help you understand how these powerful forces could play out and maybe which sectors might benefit or suffer.
Absolutely. Let's break it down. Scenario 1, inflation runs hot. So, higher than expected CPI, higher than expected PPI. The overall market trend here, likely negative. You'd probably see significant pressure on the S&P 500 and especially on the tech-heavy NASDAQ. Why? Because rate cut hopes get pushed further out into the future. The most vulnerable sectors in that case, technology, obviously. Other high-growth stocks whose valuations really depend on low discount rates. Also, consumer discretionary and real estate, REITs, which are super sensitive to rising borrowing costs. On the flip side, potential outperformers, or at least areas showing relative strength, might be the energy sector, often seen as an inflation hedge, and defensive sectors like consumer staples and utilities. Historically, value stocks also tend to do better than growth stocks in high inflation environments. So something to keep in mind. Scenario 2 is the opposite. Inflation cools, lower than expected CPI and PPI. The overall market trend here, positive, probably a broad risk-on rally. This kind of cool inflation report would essentially give the Fed that green light we talked about, right, to consider earlier rate cuts. It could really solidify expectations for a September move. In this scenario, the likely leaders would be technology and growth stocks again, consumer discretionary, and also rate-sensitive industrials and materials, potential laggards. Probably those defensive utilities and consumer staples as investors rotate out of safety and into higher beta growth-seeking assets. And finally, we have what we're calling the wild card, earnings override.
The corporate results stepping in.
Exactly. This is where strong corporate fundamentals could actually cushion the blow from weak macroeconomic data, or maybe even overwhelm it. For example, let's say we get that hot CPI print on Tuesday. Market tumbles initially. But then the major banks report blowout earnings, show really resilient credit quality, strong consumer demand, and maybe their CEOs delivers super bullish commentary on the economy's resilience. Well, this strong corporate signal could actually mitigate those broader market fears. The market might conclude, okay, maybe the economy is strong enough to handle higher rates for longer. In that situation, you might see a rotation away from rate-sensitive growth stocks and into more cyclical and value sectors rather than just a broad market collapse. It really underscores why you shouldn't trade macro data in a vacuum. Corporate performance often tells a different, sometimes more nuanced story. It really does.
Okay, let's try and bring it all together for everyone listening. What's the single biggest risk you see playing out this week? And conversely, what's the primary opportunity that could emerge from all of this?
Okay, the biggest risk, I think, is definitely that stagflationary cocktail we discussed. That's the really grim combination. A hotter-than-expected CPI report on Tuesday, followed by weak retail sales on Thursday, and then maybe topped off with downbeat guidance from bank CEOs about consumer credit or loan demand.
Yeah, that sounds pretty bad.
It is. This scenario combines the worst of all worlds. It confirms inflation is sticky, forcing the Fed to stay hawkish, while also signaling the economy is weakening under the pressure of high rates. That outcome would severely challenge that whole soft landing narrative everyone wants. It raises the specter of stagflation. And honestly, it leaves very few places for investors to hide. Both growth and value sectors would likely get hit. It would be a truly challenging environment. The primary opportunity, though, the flip side, is what we're calling a green light for a soft landing. This would come from a cooler-than-expected CPI report on Tuesday, especially in those core components, signaling disinflation is still working. Then, that positive inflation signal gets amplified if it's followed by, say, inline or solid bank earnings that don't signal any imminent credit crisis or major loan quality problems.
So inflation cools and the economy holds up okay.
Exactly. That combination represents the market's ideal soft landing signal. It gives the Fed the justification it needs to maybe proceed with a rate cut relatively soon, solidifying those September expectations. And that could trigger a really powerful, broad-based rally, probably led by the rate-sensitive NASDAQ and other growth stocks. That's the scenario that could really ignite a fresh wave of optimism.
Wow, what a week we have ahead. Truly a battle of narratives unfolding right before our eyes in the market. Hopefully you now have the key insights to understand these powerful forces at play, inflation versus corporate health, and precisely what to watch for in the days ahead. That clear point of view, that strategy, should serve you well.
And it raises an important question for you, the listener. In this world of just constant information overload, how are you going to use these insights? How will you navigate your own financial journey and try to stay ahead of the curve? Will you focus more on the macro wins or maybe on the micro resilience you see in specific companies? It's a tough balance.
Definitely food for thought. And look, if you want the fastest, most frequent updates and deep dives just like this one, make sure you subscribe to the Deep Dive wherever you get your podcasts. We'll keep unpacking the most critical information just for you, trying to help you gain that knowledge quickly but also thoroughly. Thanks so much for joining us for this Deep Dive. We'll be back soon with more.